Market Structure Mondays with Tim Quast. Sir, how was your weekend?
It was great. We had a combination of snow and 10 degrees and sun and 60 degrees in Denver, which is par for the course here.
All right. Awesome.
How about you guys?
We had kind of the same actually. It was like in the 60s on Saturday morning, and by Saturday night it was down to like the 20s. It was cold. But we had kind of the same weather. All right, Tim, let's talk markets. We were talking last week, you and I, that this week is going to be very important for a couple of reasons. We have, of course, the Fed on Wednesday. We have options expiration on Friday. Both the last such events of the year.
Right.
How are you positioning yourself into this week?
Well, you never know what's going to happen around options expirations. I've said for a long time on this program that I prefer to portage around the falls of options expirations. It will depend on what the overall sentiment, what we call broad sentiment in the market, is doing. If it's peaked into options expirations, I'm out. And it doesn't mean the market will decline. The probabilities are not in your favor when those conditions exist. And it's sort of the opposite this time, believe it or not. Broad sentiment is rising everywhere still. Even after that big surge that we had, we're still approaching 5. So historically, that has meant that we get a nice move during options expirations. Doesn't mean it will happen, but I'm a little less concerned here. Now, I might try to be out of positions by the end of Friday, but I'm not. I look at the probabilities here and say they favor us more than hinder us. I'll add, it doesn't mean that the market isn't down today or tomorrow. Those conditions tend to precede a surge into expirations, because if the underlying equities deteriorate in value just a little bit, and hedge funds with big baskets of options then can drive them up into options expirations, you can exercise those rights, force people to cover, and turn right around and sell what you just covered. And that's a very popular hedge fund strategy. If you borrow 8 or 9 times your economic interest and leverage into positions at options expirations, and that can happen. I'm not saying it will. I'm saying that there's a probability that could occur. And Dennis, you were talking about this split between growth and value.
Yeah.
And it seems to be the case, but it is not linear. You could say, look at Apple. There are growth stocks that have performed very well, but there are also oddly value stocks that have performed very well. I don't know.
What is Apple is the question too.
Right.
It's
Value
not
tech.
really growth. It's kind of value tech. So
Yes,
I throw it in value, even though the multiple is now 35 times, which is starting to make you think like people are paying a growth multiple for a value stock, which I don't totally understand. But
Yep.
I don't know what category. I kind of throw it into value tech. I don't want to throw it into growthy tech.
Could do the same with Google. And
I would say the same for sure.
And it's done well too. Yeah.
And those are values. So I would argue for the value trade continuing there. So what growth stocks are you seeing really, if you go away from Apple and Google and say they're more value? Are we seeing any growth stocks really take off here?
You have to hunt around.
Yeah.
Interestingly, so maybe I'll do this. Here's so if you've not done this with us before, folks who are listening, I'm going to take you to Market Structure Edge, and you can do this. Just you go to marketstructureedge.com, sign up with your name and email, free for 14 days, and you can follow along, and I'll show you things that we look at. I want to show you a deal stock as well, and how you might screen for those with Market Structure Edge, because there's always opportunity in those sorts of things. But if I look at, so here's Benzinga December 13, and here's the demand side should be rising and the supply side should be below the trend. That's the condition I like to see. So clearly the mix of things in this portfolio fit those two criteria. So if I look at things that might rise that are growth stocks, the weirdest one of all would be Alpha and Omega. But this is exactly the kind of condition that you want to see in a growth stock. So it's spending a lot of time at 10. That is, it's all the way to It's banging against the ceiling because there's excess demand, and the supply trend continues to be trending down. This can signal maybe a bit of a slowdown, but those kind of stocks have done very well. I would say, once again, Synaptics did very well. HP did very well. Lam Research, all of these are stocks that have fit those criteria that I've talked about. And so those are some examples of growth stocks that have been terrific. The funny thing, back to your point, Dennis, about growth or growth versus value split, here is Pepsi. And we talked about Pepsi last Monday. I said, you look at that and steady demand and supply dragging below the trend, that's likely to rise. And it behaved like a growth stock.
Well, they're behaving because it's flight to safety, like Pepsi. So if you're just throwing it even all those stocks, Lam Research, I would put Lam Research as a value tech stock. I wouldn't put it as a growth stock. And Pepsi, I would put as a staple. So what we're seeing, and maybe didn't hear us right off the hop, but right after 8 o'clock, we're talking staples, utilities, and value tech. That's where the money is moving. Tina trade. If you're sitting here and you're worried about equities and you're like, okay, well, I'm, worried about the stock market, but I don't want to go to cash because I'm guaranteed losing in cash to inflation right now. Where do you go for safety? Staples, utilities, value tech. That's the hiding ground. And all those stocks you're mentioning right now kind of fall into that category.
They do. Yep. Procter Gamble. Here's another.
All-time high staples.
Very same thing. Yeah.
Yep.
Rising demand, steady supply. That's the kind of thing that produces gains. And it started here. It started actually at the end of October. This is where we saw the big disconnect between supply and demand, and we saw it all over. Interestingly, so I remain somewhat of a skeptic about the staying power of this trade because of the enormous reliance of the market on growth stocks. They comprise such a tremendous amount of market cap that unless we're done with these big surges in the market, money will have to come back to them. And Spencer, we talked about this a little bit on Friday, how passive money has to get a bunch of rebalancing done. There are inflows into the market that have to be deployed before the year ends. It's happening now. And we haven't seen that effect yet in the market. So I still think there could be surprising opportunity in even things like Netflix and Shopify. You can make a case against it, but we'll see what happens here in the next week, to me.
And then the chat is, following up on this thread here, things like commodities, right? Which are also typically considered
inflation hedges.
Yeah, lower beta inflation hedges, quote unquote, safer in quotes than stocks.
Building materials. You can look at the supply demand balance here for I've got 7 companies in this portfolio. Looks very good. If short volume is falling and demand, which is an algorithm that calculates demand from all the different purposes that drive buying and selling stocks, looks like that's pretty good. You could look at home builders. With wood prices rising, it's not necessarily how I think about it, but I look at that and say, wow, now the run might be just about over, right into options expiration. So if you own home builders, that might be the time to leave, because look how high demand is now, pushing toward 10 for these 8 companies comprising that group. But it fits the thesis, Spencer, that commodities in an inflationary environment clearly are going to work. That I don't. We think differently than a lot of folks. I'm going to go to supply and demand, short-term changes in those. That to me is how we as retail traders can compete with high-frequency traders. It's the only way. Otherwise, they will run circles around us because they have better data and faster machines. To reference it, so this, you'll have to go hunt for this, youngsters. But it's as Roger Miller said, don't roller skate in a buffalo herd. It's the wrong equipment for right. It's a great song, but it's very old. So we want to make sure that we're not the ones wearing roller skates in the buffalo herd. And that's why I think supply demand always trumps. It will tell you where the money is going. I could look at every trend right now, despite what we're seeing, the bifurcation toward value. If I look across every portfolio here, there is an uptick in demand, and the supply side's pretty weak. It says it's possible And again, I'm not saying this will happen, but it's possible that the whole market goes up 1,000 points, that the Dow goes up 1,000 points this week. Again,
Well, the
I'm
value
not saying
stocks
it's
could
going to
keep
happen.
carrying us here. So you're still
They
seeing
could.
strength in the value names.
Yes, to me, that isn't done,
Bring up a
particularly
Ford.
into options.
Let's bring up
Okay.
a Ford, because this is a
Okay.
good example of the stocks that we've been talking about. Obviously, I own Ford in the long-term account, but I've been talking about, here's your way to play EV, and it's not expensive. I mean, you're talking about a company that's trading 9 or 10 times earnings, and it's starting to get the story behind it as well. What's it look like from a supply-demand perspective, though?
Well, so I would say this big jump for supply over the trend, that can be additional demand into options expirations. It is a supply demand imbalance, but it goes back to a core. There's this fine line when you have a deficit in supply, then a surge in supply, and it accompanies options expirations. It can mean that market makers are creating stock to fill orders, and those orders are tied to call options. Again, I'm not saying that's absolutely the case, but we're well below 50% short volume. So the principle applies, but that can happen right into options expirations, and you can see Ford move 3, 4, 5%.
General Motors, similar chart. Just curious, because we're seeing, obviously, from the technicals, General Motors approaching new highs as well here again. Just wondering your supply demand. We're just cherry picking some stocks here.
Yeah. That's very positive. So there's not a creation of stock to fill derivatives demand, but that's a very nice ramp. We have demand rising, and supply took a big dip. So it's very easy to understand logically. There is a supply chain. If everybody rushes to buy Christmas trees, there becomes a deficit in the supply chain for Christmas trees. There aren't enough. So then what happens? The prices go up. The only difference is that this weird little feature of the stock market, where market makers are exempt from having to locate shares to short, which is why you want to make sure you short stuff where you have a high probability of wins. And that's a whole separate topic. But that's the only difference. Otherwise, this will almost always produce a gain, particularly into options expiration. So I agree. It shows the same thing, Dennis.
What about Harley?
Maybe Harley, yeah. Jochen Zeitz.
The one problem, does this adjust on the fly? Harley Davidson's up 12% here this morning for pre-market data. So does your data, it's not going to adjust that quickly because it's slower, looking at, the overall trends.
But we want to know if that's coming,
spike.
Right? We want to know if that's coming. And the data would actually suggest that there was some indication, and let's look at Arena Pharmaceuticals too as an example. Because
this is curious because how was it looking like before the action happened?
Right. And I want to look at ADP. I'm not saying ADP is going to be in a deal, but I'll show you the data. So see this demand ramp, and all of a sudden, boom, the short volume drops. Those are conditions precedent to deals. I would say not a lot of people saw this SPAC deal coming. So they're spinning off Livewire, which is their electronic hog business, in a SPAC. And so that's why the stock's way up. You could say there's a little bit of an indication. Overall, I'd look at Harley Davidson and say, that's not great. It's having a hard time getting back above 5. And if that's the case, it's difficult for price to rise. So let's go look at Arena. So those of you watching the news, Arena was bought for basically 100% premium
by Pfizer.
So was there any indication in the data? Well, the indication, so internally, and we've been doing this a very, very long time for public companies, one of the things we will look at is when short volume drops below 30%. So believe it or not, the market runs about 42 to 45% short. That's the supply chain. So stock that is either borrowed or created feeds the market's capacity to fill continuous electronic orders. And so when there's a deficit, what it can tell us is that there are people who know things are happening, and they say, well, we don't want to have our shares out on loan. So things like that will incrementally drive the cost of borrowing up. And we will see that in a decline in demand by automated systems that are just running around and borrowing cheap stuff. And they don't have to. If there are surges, their higher priority is to fill the bid or the offer. But Look at this. So this is where short volume was for Arena right before the deal. It was 24%. So below 30%. Those are things to look for. I want to show you ADP. Again, I'm not saying that ADP is suddenly going to be in a deal, but these are interesting features to think about and something you could actually screen for. You could go look for stocks that are at 5 and have suddenly dropping short volume using Market Structure Edge, and look at this. So here's demand, steady, and look at that plunging supply side. Well, in most cases, that will.
Why does it do that? Why is the supply plunge? Like what in, like, I don't want to give your secret sauce away, but what is it that's causing that to happen?
The simplest explanation is it means there's a sudden decrease in borrowed stock in the market. And think of that as supply, not that you have to check your old presumptions at the door. It's not people shorting the stock. It's the supply chain. It's a supply chain disruption. And it likely reflects higher cost to borrow because machines will do that first, even though they're exempt. And look what happened here. Right at October expirations, this happened too. So big drop in the supply side right at 5, and that's where the stock took off. So could that happen again? Well, it could, right? Could happen. It could also mean that there is speculation that ADP could be sold. I'm not saying, again, that that's going to happen, but we have tracked this data for a very long time, and routinely that happens. So just another way that you can find opportunity traders. You know that you're in a pretty good trade when that condition exists, regardless of what the outcome is.
Tim Quast runs Market Structure Edge. Link is in the chat, marketstructureedge.com. Tim, always a pleasure. We'll talk
back at you guys
next week. Have a good one.
You too. Good to see you.